As the Federal Reserve keeps raising rates, many of us are wondering how we should best deal with the rising interest rates. Within a matter of months, the mortgage rates have doubled and borrowing money in general have gotten significantly more expensive. But for financially savvy investors like yourself, you see opportunities when others see fear. You know there are smart ways to navigate the high interest rate environment so you come out better and stronger on the other end. Hi, if you're new to the channel, my name is Tay from Financial Tortoise, where we learn to grow our wealth slow and steady. If you're in your 20s or even your 30s, you grew up in a low interest rate environment pretty much your whole life. So you might be shocked by the cumulative effect of the Federal Reserve's campaign to stamp out inflation with higher interest rates. If you've been in the market for a new home, you might feel like throwing in the towel. If you have credit card debt, you might really be feeling the squeeze. And if you have money invested in the market, you might feel like the temptation to do something, like sell. However, fear not. There are ways to navigate this high interest rate environment and come out even better on the other end. In this video, let me share with you 5 strategies to best navigate the high interest rate environment. But before we get into specific strategies, let's talk about how we got here in the first place and what effects it has for the general economy. When we hear about the rising interest rates, the first question that many of us ask is this: why is this happening? Or why is the Fed raising rates? Just because they're bored? Of course not, or I genuinely hope not. The Federal Reserve, the nation's central bank's key role in the government, is to keep the economy stable for the American people. Its job is to keep inflation in check and help the job market grow as much as possible. Therefore, when inflation is high as it is right now, it uses interest rates as a mechanism to control inflation. This past year, we've seen prices rise sharply for a variety of goods and services as strong demand collided with persistent supply shortages. Some highly consumed items like meat and bread became 10% or even 20% more expensive. The Fed raises or lowers its benchmark rate, known as the federal fund rate, and this influences how much banks and other financial institutions pay to borrow, which in turn influences how much businesses and households can borrow. In general, lower rates help stimulate the economy by making it cheaper for businesses and households to borrow money. The Fed did this following the housing crisis in 2007 and 2008. It did it again in 2020 during the COVID-19 pandemic to a record level of near 0%. Higher rates do the opposite and are designed to slow the economy by dampening consumer demand and in turn ideally help to curb inflation. Less demand, lower the price. The Fed hiked the rates in 2005 to 2006 to cool off the economy and the growing real estate bubble. Now, the jury is still out on how well the current raising of interest rates will bring down inflation, but nonetheless, it seems to have made an impact on the current stock market and the general economy as a whole. Since the beginning of 2022, the total stock market is down 18% and the S&P 500 is down 20% from the same time last year. However, as history and general market economics have shown, this is a normal byproduct. Higher rates typically cause market dysfunction. This is partially by design. High interest rates are designed to slow the economy down. Borrowing becomes more expensive, companies take out less loans to create new products, and consumers spend less on buying these new products, especially those that require financing. So you might be thinking at this point, I got it, Tay. Stop yammering about the economy and the Fed. Give me some actionable tips. All right, not a problem. Let's talk about 5 strategies to best navigate the new high interest rate environment. The number 1 strategy to best navigate the high interest rate environment is to pay off all high interest debt. I know it's not an exciting strategy, but there is a reason I want to kick off with this one. In a high interest rate environment, you have to treat high interest debt like fire in your house. You have to prioritize taking that fire out because once it starts engulfing other parts of the home, it gets extremely hard to get out from under high interest consumer debt. According to the Federal Reserve Bank of New York, the total credit card balance in the United States hit close to $1 trillion, and student loans hit close to $1.6 trillion as the second quarter of 2022. Both record high numbers. For credit cards, where the interest rates vary, high interest rates drive higher annual percentage rates, or APRs, making it even more costly to carry debt. According to Bankrate, the average APR on credit cards reached 18.73% in October, up from 17.35% in the start of 2020. The average credit card balance is around $5,200. If someone only makes a minimum monthly payments on their average credit card balance, it would take them an extra 3 months to pay off that debt. I don't know about you, but these numbers terrify me. And in a high interest rate environment, it should terrify you as well, especially if you have high interest debt that you've been carrying month to month. If you don't get it under control, it won't matter what else you're doing with your finances. This fire can and will consume other parts of your financial home. So before you do anything else, tackle and destroy high interest debt. And there is no easy way to knock this down, except to just do it. List out all your high interest debts and create a plan for getting rid of them. You can use the debt snowball method or the avalanche method, whichever one that best motivates you. You want to minimize risk in a high interest rate environment, and one easy way to do that is to get rid of high interest debt that will be directly impacted by the high interest rates. The number 2 strategy to best navigate the high interest rate environment is to find ways to earn more from your cash. Now, if you watch any of my other videos, you know I love holding cash. They don't provide great returns, but they pay in multiple other ways. Not only does cash allow you to buy opportunities and ride out uncertainties, but it gives you, most importantly, mental and emotional peace, allowing you to make the best financial decision without being rushed and pressured by the lack of liquidity. Now, for the past decade, it was almost impossible to earn more than a fraction of a percentage on your cash, given how low the interest rates were. However, during times of high interest rate, you can find places where your cash can earn a higher interest rate, almost like having your cake and eating it too. Yes, banks have been slow to raise rates on standard savings account, but the general rule of thumb is that Fed rate increases should lead to higher returns on savings. If you shop around, there are currently high yield options available. Start with your current bank and make sure to ask around. If you're willing to move your money because you aren't tied to a current bank, banks like Capital One and Goldman Sachs Marcus are offering a 3% in annual percentage yield. A year ago, you would have been hard-pressed to find an account with even 1/10 that interest rate. So a 3% interest rate on your cash is a refreshing silver lining in a high interest rate environment. The number 3 strategy to best navigate the high interest rate environment is to reconsider your house purchase. This one is a hard one to swallow if you've been in the market for a new home. But when interest rates rise, one of the biggest categories of borrowing that it impacts is the mortgage market. Changes in mortgage rates that ultimately affect homeowners' monthly payments. When you run the numbers between different interest rates, you'll notice that higher mortgage rates can add hundreds, if not even thousands of dollars to monthly payments. And it doesn't help that starter homes are harder to find across the country. According to Freddie Mac, in October, mortgage rates topped 7% for the first time in 2 decades. This is more than double the 3% rate that many Americans could get on a 30-year fixed-rate mortgage a year ago. A $400,000 mortgage at a 3%, 30-year fixed-rate mortgage would have had a $1,700 monthly mortgage payment. Today, the same mortgage at 7% interest rate would cost you $1,000 more, $2,700 monthly mortgage payment. And that is just the payment. When we compare the total interest paid for the duration of the loan, the impact is even more sobering. For a 3% mortgage, you would have paid a total of $207,000 in interest. In today's interest rate environment, at a 7% mortgage, you would pay a total of $560,000 in interest. A difference of more than $300,000 just in interest payment. Think hard about a home purchase right now. Delaying the home ownership process can hurt at first, but it gives you additional time to save for a bigger down payment. And there is a chance home prices could also drop in the meantime. Of course, no one knows for sure, but a way to best navigate through a high interest rate environment is to minimize risks in your life. We just don't know how much interest rates will go and when it will turn around again. If you're really stretching your budget to make that 7% interest rate mortgage work in your finances, it may be time to step back a little and rethink that purchase. The number 4 strategy to best navigate the high interest rate environment is to maximize your credit score. You and I can't do much about the Fed. If they want to raise rates, so be it. We can complain all day long about how unfair it is, but that is a reality of living in today's world. However, there are still things that are in our control that can have an impact on our ability to borrow at the best rate, and that is our credit score. Outside the Fed, personal credit score has the greatest impact on a consumer's ability to borrow money at the best current rate. Financial institutions save the best rate for their safest and the best borrowers because they know based on statistics, these borrowers will pay back money borrowed on time and in full. And a good to excellent credit score is the best indicator to identify who these safest and best borrowers are. And improving your credit score doesn't just impact the interest you pay on your credit card debt if you're looking to pay off high interest loans. It saves throughout all aspects of borrowing, including auto loans, student loans, and mortgages. To have the best credit score possible, I recommend concentrating on these 2 factors: making all your debt payment on time and keeping your credit utilization ratio as low as possible. These 2 factors have the biggest influence on how your rating is calculated. A strategy I like to use to keep my credit utilization ratio low is to call up a credit card company and request an increase in my credit limit. If you have a history of making your payments on time and have an excellent credit score, this should be an easy request for the credit card company. And just a note, just because you have an excellent credit score doesn't mean you have the permission to go out and borrow more money. Remember, this is a high interest rate environment, so you want to be very cautious about taking on additional debt. You want to maintain your excellent credit score in case you want to borrow in the future, but also to prevent yourself from getting into more high-interest debt. And if you do have to borrow, it's best practice to shop around for the lowest rate possible and never spend more than you can afford to pay back. The number 5 strategy to best navigate the high-interest environment is to ignore the market volatility and stick with your long-term investment strategy. Buy and hold, and then buy some more. So far, we've talked mostly about defense strategies, reducing debt, maximizing credit score, and rethinking home purchases. However, we don't want to just survive through a high-interest rate environment. We want to come out the other end stronger and better. And a sure way to do that is to see the opportunity when everyone else is seeing uncertainty. As I mentioned earlier, when the Fed raises interest rates, this in turn raises borrowing costs. And when borrowing costs go up, it has a ripple effect of tapering growth and consequently fueling market volatility as businesses and consumers try to navigate the market uncertainty. And we don't have to look far to see this. As I mentioned earlier in the video, since the beginning of 2022, the total stock market is down 18% and the S&P 500 is down 20%. But if you're a long-term buy and hold investor, this shouldn't mean anything. You have decades ahead of you and you want to constantly invest more as you go. These market dips are just a blip in your long-term investing journey. Just take a look at a chart of the S&P 500 in the last 100 years. We've had similar rising interest rate environment in the past. But if you have confidence in the American economy, the trend is and will be up. So you'll recognize a 20% drop in the market as the stock on sale buying opportunities that they are because you are a savvy, smart investor. Use the market uncertainty created by the high interest rate environment to your advantage and just keep buying. The ultimate goal with rate hikes is to give the economy a soft landing, slowing inflation, but not too much that it tips the economy into a recession. But that is a tall order, even for the US central bankers. Let's hope that it doesn't get any worse than it is right now, but that doesn't mean we idly sit by as spectators. There are strategies we can implement to safeguard our finances as well as take advantage of opportunities. Thank you guys for watching. If you'd like to learn more about how to thrive during a bear market, check out my video here. Until next time, all the best.